The Pro Show is brought to you by Rockin' Media and our proprietary Flash HDR photo process, providing you with the best, most realistic photos of your property. See the difference at rockinmedia.com. Hi, and welcome to the Pro Show. I'm Rick Machle, and on today's show, we're back talking to Nancy and Kristen about mortgages and specifically when you should refinance and what are the considerations to get you there. That's a great topic. There's a lot to talk about there, and we're going to do so next on the Pro Show. A couple weeks ago, we had Nancy and Kristen on to talk about mortgages, and everybody loved it so much. We are going to continue the discussion with both of them. We have Nancy Alexander from Smart Mortgage Services, and she's here in the Evergreen, Denver West area. And then we also have Kristen Buono from KB Real Estate and Lending. Hello, ladies.
Hello.
Hi, Rick.
Hi, Rick.
Great to see you. It's great to see both of you. So today, I think what we want to do is talk quite a bit. This is going to be kind of a mortgage episode, all about mortgages. But as everybody who has a TV or radio or an internet connection knows, we're going through a little bit of turmoil in the stock market. And so what I want to talk about today is obviously there are some people and big institutions that are, fleeing to bonds, which means that I think yields are down, which means that there's then mortgages that are being a little bit more affordable. That's all great, which means people are probably talking to you about refinancing. So let's talk about that process and what you need to consider when you're refinancing. Who wants to start out? Kristen, you want to start?
I'm happy to start, Rick. Thank you. The fun part about the refinance is everybody jumps on the bandwagon. Everyone's like, oh, yay, the rates. Oh, yay, the rates. And then, what people forget is there's a cost to everything. You've heard me say this, mama's not free. Things aren't free. So you have to just remember, and we do this with our customers all the time, is go through what the cost is. And does that cost, you either bring cash to the table or you increase the loan, and depending on what your play is, like when are you going to see that money come back? So you really want to dive into, does this make sense? Especially like even the cash outs, does this make sense? It might make sense if you've got some hefty bills you want to pay. It's such an individual decision, in my opinion. I've told people, this just doesn't make sense yet. We're not there. And if we're in the high fives today, maybe we need to get into the low to mid fives to make this work, just depending on what everyone's situation is. Does that make sense?
Yeah, and it doesn't matter necessarily. You can't say, well, if you got your mortgage at 7 and now it's at 6, you should do it, because it's not necessarily that simple, right?
No, I talked to a guy this morning. As a matter of fact, it's an investment property and values there. We were barely, loan amount was not super high, but when it was all said and done, it might have been a $79, $82 less a month payment. And it just didn't fit what they want to do with the property. So we're going to wait and see what happens.
Yeah. And so what, Nancy, what are some of the costs? If nothing's free, I mean, what do I have to do?
Right.
I guess it depends on how long I've had my mortgage, right?
Right. Well, I think Kristen brings up a really good point. And the point is that a lot of people will say there's a rule of thumb that if it's a point different in rate from where you are now, you should do the refinance. And I would disagree with that, because it's based on your loan amount, right? You have an $800,000 loan amount versus a $200,000 loan amount. You're going to need less of a spread at $800,000 between those rates than what you do at that loan amount at $200,000. So to answer your question, Rick, a cost, you're looking at lender costs, you're looking at possibly an appraisal if you're not getting an appraisal waiver, and you're looking at title. And so $2,800, $3,000 you should come in somewhere around there for your costs. But what people don't talk about is that you've got your escrow cost, right? So you've got your escrow bucket with loan A that you're going to get refunded to you, and then you have to feed that escrow bucket on loan B that you're moving to, that you're doing the refinance. And so that's a cost to you, and it's not getting refunded to you until after loan A gets paid off. So you've not only got the hard cost of closing, let's call it 3,000, you can even say let's call it 3,500. And then you've got your escrows that you have to fund and then get the repayment back on. So what I hear, and Kristen, I'm sure you're hearing this as well, there's a lot of investors out there that are saying, oh, we'll do a refinance for free.
Yeah.
And it's like,
Nothing's for free. If you walk away with anything in this next half an hour, nothing.
So that whole free thing, it's like free doesn't mean I'm going to roll all the costs into your loan and you don't have to pay anything out of pocket, because now you're paying that increase in your loan year after year, or I should really say month after month, year after year, for as long as you keep that mortgage. So I think it's so important, you guys, to talk about to your loan officer, what are your goals? How long are you going to stay in the mortgage? What is that differential between the rate you're at now and the rate that you're going to? So,
Yeah.
yeah.
What's interesting too is, there's this buzz, the refinance boom, the refinance boom. Ooh, yay. And we all go back to 4 years ago. Well, it was kind of a stupid boom. Sorry, but we were at 4 and 5 and we got down to, under 2 in some cases.
Right.
So there was the boom, and there was, I kind of call it almost free money when you're at, even though I just said nothing's for free, but if you've got a 1 or 2% interest rate on a $400,000 loan, that's where you see,
Yeah.
Now fast forward, we're in 2025, trying to navigate what that means. And when you pencil it all out, like you said, it may or may not make sense.
Yeah. Agreed.
Yeah, so you really you have to play the numbers, and you have to figure out, okay, and maybe Nancy, you can go into a little bit more about the 200,000 versus 800,000, probably because the difference in what your mortgage payment's going to be is going to be so much less.
Sure, because Rick, think about, if you've got a mortgage, and I'll just do simple math. If you've got a mortgage at 800,000 and your rate is 7%, 8 times 7 is 56, right?
Okay.
So I could say your principal and interest, I would be close by saying your principal and interest is 5,600. If you have a $200,000 mortgage at 7%, your PI, principal and interest, is 1,400. I have to have a greater gap between rates for that 200,000. So in other words, 7% to 6% is going to take me from 1,400 to 1,200. That's a $200 gap. Now, that's not a bad savings, but again, what we're going to do is say, okay, if the cost is 3,500, divide the 200 into the 3,500, divide by 12. Can you break even in less than a year? Right? We're always saying, if you can break even in a year or less, take the refinance, right?
That's for rate and term. So that's just for rate and term.
That's just right for
a whole other conversation. Sorry, I don't want to interrupt, but there's a whole other conversation with cash out.
Right. Well, cash out brings a whole different dimension to it because, because you're cashing out, you guys. And so what Kristen's bringing up is valid, is that you have to be able to say, okay, if I'm going to pay off this car payment and the car payment is $800 a month, right? You have to take that into what your savings is for the differential in rate as well. Right. And it's not as complicated as what it sounds, but it's not free. Do you really want to roll it into your mortgage, right? I mean, if you're only going to stay in your house for the next 3 to 5 years, maybe you do want to roll it into your mortgage, right? If you're staying in the house until eternity, then maybe you don't want to pay that additional 15,000 onto your mortgage month over month, year over year. So I think the hard thing is, Rick, right now, and what Kristen and I are seeing and hearing is that those rates are just beginning to drop. That yield just got under 4% today. And that's the first time in a year that we've seen that yield get under 4. So yes, it's monumental, but it's just the beginning. So do you grab your refinance right now because you were sitting at 7.5 or 7.75 and somebody's offering you 6.5? Or again, where's the mortgage amount? Is it sitting at 800,000? Is it sitting at 6? Is it sitting at 4? Like Kristen said, are you taking cash out or you're not? You bring it all into circle with your loan officer to say, is this my strike? Right? Is this my strike point? And if it's your strike point, in other words, it achieves all the goals you're looking for, checks all the box, then get busy on it. But know that this rate is going to continue to drop due to the uneasiness of the equity market versus the bond market. And remember, those are the two markets we get to invest in, right? We're either investing in equities, which is we're buying into somebody's business because we believe in it. Disney, right? I always use Disney, IBM, right? Bonds, you're buying in to your country, essentially, right? It's that 30-year bond that your country is creating for roads and bridges and dams and power grids and etc. that they're creating for us as investors to then buy into. So, and it's not just us, right? We're talking, really, it's not us. We're talking institutional investors.
And so what should I be thinking about as an end consumer then relative to making this decision? Is it just looking at the numbers? And the other thing I was thinking about as you were talking, Nancy, and maybe Kristen or either one of you can go into, when you were talking about the escrow money, that's not an extra cost. It's a cash flow issue, right?
That's perfect.
It is. It's actually, yeah. And what, and the discussion always is, we have to rebuild that for the new loan. You're going to get what's in the other loan back. Don't spend it. Maybe apply that to principal on the new loan because that, it helps bring, that mortgage down. I have that conversation because again, it's well, my loan amount, Kristen, my loan amount, I only want it's just rate and term, and so we do have that conversation. The other similar conversation on your rate and on your cash out is, hey, you know what, you're still going to see, you're not paying 10% interest on the car, you're not paying the 21% on the credit cards, so you're going to pay those off. We're not going to use the credit cards anymore. And that payment difference, pay it towards your principal. If the goal is to get the principal down, then pay it towards the principal or throw it into savings. And, have a, no one has any savings. They, let's be honest, a lot of people don't have a savings account.
Right.
Let's get a savings account. Growing up, that was the biggest thing was, the Christmas club. And every week you put $25 in the bank for the Christmas club. And at the end of the year, you get all this money for Christmas. So guess what, people? Start saving that money and stop spending.
So I was always taught by my parents that you're paying toward your mortgage or paying in advance toward your mortgage or ahead on your mortgage is that forced savings, right?
Yep.
Absolutely.
Absolutely.
And Rick, you and I have talked about the 15-year versus the 30, and I think Kristen and I were chatting about it the other day as well, is that I had a client that said, okay, so wait a minute, if the 15-year is 3/4 to a point below the 30-year, and I'm taking a chunk of money and putting it into my mortgage, so she's doing a no cash out, she's actually bringing a chunk of cash to the closing, the 15-year made so much sense for her, and we've always called that 15-year forced savings account. Right, the 30-year you can jockey around on, right? The 15-year you really can't. But the blessing of the 15-year, your principal is more money is going to your principal than your interest with the first payment out of that 15-year.
That's huge because it's so small on a 30, the amount you're paying toward the principal, it's almost all interest. And
there's those calculators. Sorry, Rick, there's those calculators, and you can, have this conversation, especially if you're. I always call it the last chapter, the last chapter of life. Not to get sad, but you only have a certain amount of time, and you want to get it down as much as you can. And even if it's 200 or 300 more, just make that extra towards principal, or put some of that, put some of the money in savings, and then, start paying a little bit every month towards principal. It is your Christmas club money. It is your, you don't get to spend it for Christmas, but it is a forced savings, and it does give you, that equity position. It gets a little bit stronger as you go along.
Let's talk about,
I think,
go ahead.
go ahead.
Nancy. Go ahead, Nancy.
Well, I think what people forget is that when you look at an asset portfolio, right, you're looking at your checking, your savings, your money market, your CD. So take that pie like we used to make, and split it into eights, right? And mark each little slice of pie for where your assets are. Well, real estate is in there. Right. So you're not, I talking to a borrower this morning, she's like, I feel like I'm just dumping all of my cash into this transaction. And it's like, well, you are. But it's all you're doing is moving your equity position from your checking and your savings over here to your real estate. Right. It's still your asset.
Right.
And you're still getting a rate of return on the asset, sometimes better than what you're getting in the marketplace, right? You're picking up that 7% rate of return, that 8% rate of return, depending on where you're purchasing in the country. And in turn, it's just a shift. So if you can keep that in mind, it's not as though it's a depletion.
But as you talk about equity, unfortunately, there were some people who bought 3 years ago in the boom and paid $50,000 over what list was, and now they want to sell. And I assume part of refinance is you have to have some equity, right?
Kristen?
Absolutely, yeah. Especially on your cash outs, you need at least 80% prior to that. And it, let's face it, it's a protection for the lender, it's a protection for the property, it's protection for the seller too. But yeah, you definitely need to be in a pretty decent equity position.
When you say equity, Kristen, like equity position, what you're saying 80%. So you're saying 80% of the value of the home. Right, the loan.
Yes, less.
Okay.
Less the loan amount. Yes.
Right.
But if I have, let's just say, I was at 80-20 when I bought the house, 80% equity, and I put 20% down, and now my house value is down, I potentially could be 83% to 17. Now I've got MIP, or mortgage insurance premium, right? Which you have to consider as all part of those costs, correct?
Right. Well, like Kristen was saying, you can't exceed 80% LTV, loan to value, if you're doing cash out.
Okay. Oh, cash out. I was just saying a standard refi, just to get a better rate.
No cash out refi, right? You can go up to 85% now, and you can pick up that MI, but you're not going to like that rate.
Right, because you're now paying a higher rate for that, correct?
Right. Exactly.
Well, we're talking about rate, and you're getting the, the buzz of, rates are coming down, rates are this, rates are that. So we got to remember, it's not just the equity position, but it's the strength. It's really it's a buying position, and it's the strength of the credit. It's the strength of the income. I mean, there still are, unless it's a VA IRRRL, and we'll talk about that, you're probably, what's that? But unless it's a VA IRRRL or it's a streamlined FHA, there's still, on a conventional side, you still have the, regular qualifying conditions.
And isn't there a time, though, Kristen, that you have to be in your home before you can even consider it? Or does it depend on your lender?
Well, perfect world, us mortgage brokers don't want you to do it in the first 6 months of the new loan.
Okay.
That would be perfect world. But yes, yeah, and it would be a little tricky, I would think, in this market. I don't think we're quite there yet. If they've had it less than a year, I don't know. I think 2 years, you're gonna, like you said, you'd have your 7.5, 7 1/4 from 2 years ago.
But how much are you, if I'm going to go through this whole process, obviously I have to get another appraisal. What's going on with verification of employment and all that stuff too? Does that come into the mix again?
On a conventional loan, yes.
Okay.
Traditional Fannie Freddie conventional. However, there are, dive into the off the beaten path, no income, no ratio, then you don't have those. Your VA IRRRL interest rate reduction, not necessarily. And same with your streamlined FHA, limited documentation.
I would love you to go into that VA IRRRL for those people who are in the military who probably know what this is, but I'm not in the military, never have been, so I am totally confused what you're talking about there.
The veteran is really, Nancy, you can jump in here because I did a few this last 30 days, so it's kind of fresh in my head. The veteran is really protected with the benefit, number one. So we have to do the net tangible benefit to the veteran. So if the net tangible benefit, when that means if there's with the cost of the refinance, if that difference in payment is not made up within 36 months, then the veteran cannot do the refinance. So the argument could be made, well, what if I want to anyway? Well, you can't, veteran. It's a protection for you. Does that kind of make sense?
But
go back into the IRRRL, Kristen, that the IRRRL stands for first interest rate reduction refinance loan, IRRRL, and only the veteran gets to do it. And it's a non-qualifying RIC loan to my understanding, it's a non-qualifying loan because the veteran already has the loan, and all they're doing is reducing the interest rate from A to B. Right. They took the loan out at 7%. They can now pick it up today at 5.75, no points. So you introduce the IRRRL and bring it on that exact same property. Your closing costs are much less, about a third of what a regular refinance would be. And you've got the benefit there if you're going, again, in that scenario, 7.25, 7.5 to 5.75 of today, then you can do that, right? Then the IRRRL it's a beautiful loan.
But you still, to your point, you still have to rebuild. I always say rebuild the impound account, and then same thing. Just had the conversation last month about taking that refund and then paying the new money.
Now, and that's interesting that you do that, because wouldn't you I look at it and say, okay, you get the escrow comes in 30 days after you close on your refinance loan. Your refund of your escrow comes back in 30 days. So all you're doing is replenishing the account you had to pull the escrows out of to build the new account.
Correct.
Okay. But if you're refinancing with the same investor,
you can't.
Right. If you're refinancing with the same investor, then you can switch account A to account B, and you don't have that interim to wait for the 30 days.
Correct. We call it net escrows.
Right.
Some lenders will do it. Some won't. Just depends on,
Right.
And if somebody came to you to handle a VA mortgage, VA loan, that's something you guys handle, or do they have to go somewhere else to make that refi?
Oh, hell no. They come here.
Okay, so you handle it for them. That's good.
Come on now.
Well, I don't know. Maybe you go to some federal department that no longer exists order to.
Don't do it.
Okay.
Don't do it.
Okay.
Stay away from those people. If you want to know who they are, call us, and we'll tell you who not to go through.
Okay, but it's something they would come back to you to handle and see whether it makes sense. So you'd rerun the numbers and all that. Obviously, if you're on a conventional though, and let's just say you're in the process of going through a job change, or your wife just lost her job, or your husband lost the job, probably not a good time to refi, because you're now looking at one income, right? Versus possibly two that got you the loan, right?
I mean, again, it's a situational, like Kristen said, you know, even if somebody loses their job, if somebody loses, then does somebody else gain, right? In other words, is the other person, did they get raises that cover the loss of the one? So
Sure.
it's again, it's taking the puzzle, piecing it together, what makes sense, what doesn't. And this isn't It's not something that takes days to do. It's not something that takes hours to do. You know, we're talking to the client, you know, client after client, really at this point of saying, okay, let's talk about your story. Where are you standing? When did you buy the house? How much did you pay for it? What's currently outstanding on the mortgage right now? What's your current interest rate? What type of product are you on? Conventional FHA, VA, USDA? Was it a bank statement loan, et cetera? How did you set this original original purchase up that you're now looking to refinance? So,
And are there any other considerations I need to be thinking about when I'm looking at a refi?
well, I think where is the market going and what is the purpose of the refinance? Is it to save a couple $100 and all? You know, it used to be that we would flip refinances every 3 months and you could do it. Kristen mentioned in the beginning of this that we want you to be in that mortgage. Fannie and Freddie want you to be in that mortgage for 6 months for a no cash out refinance. Then they wanted you to wait 12 months to be in that mortgage for a cash out. Well, they rescinded that recently, and now cash out or no cash out is sitting at 6 months. And the reason for it is, again, they call it churning, because the servicer takes money and time to set that mortgage up that you and I are going to make money to that servicer, right? Or pay our money to that servicer. And so in turn, you can't just flip and churn out of mortgages. Because remember, you guys, you know, a lot of people will advertise, you know, you get 2 months free. Right? You don't have to make your mortgage payment for 2 months. I always love that one too.
No, nothing's for free.
Yeah, nothing's for free.
We're back to Kristen's.
Right? I mean, it's because of the way that mortgage interest is collected on a mortgage loan that you get that perception that you're not making a payment for X amount of time. But that equation comes into that churning. And that doing this every 6 months. So again, if you think the market is going to continue to drop, do you want to hold tight right at the moment and kind of continue to watch where things are going? And as you said earlier, Rick, and I don't think you used the term, but the market's volatile. What you see today is not what you're going to see on Monday.
Right, right.
Tuesday, Wednesday, Thursday, Friday, right? It changes every single day. And today, like Kristen and I said, bonds have stayed positive all day, meaning the yield is sitting in a positive position all day. And yet we've had two pricings for the worse.
Right.
Because the bond market opened up so incredibly strong with bonds this morning, and it has gone, we've lost that position. We're still positive. We're still sitting at that yield below 3.9, but we've lost the large positive that we had, and we've moved down to a smaller positive, if that makes sense. So in turn, the lenders have pulled back on those rates and said, okay, we're going into the weekend. We've lost some equity position in the market. And so in turn, we're gonna reprice. And that happens in the middle of the day all the time, you guys. What we're pricing in the morning, we could be pricing differently in the afternoon because of that volatility.
So we tell people all the time, you know, sorry, Rick, just to dovetail. Yes, with the refinance. Also, how long are they going to stay in the home? That's the other caveat to it. If they're going to stay there forever, then maybe hang tight and see what the better play is going to be. But Nancy, to your point, people, will have a conversation in the morning, and next thing you know, you jump on there and you're looking at pricing. It goes back to people say, what's the rate? Well, I don't know, because it's changed 3 times today. What do you mean it's changed? What do you mean? It's like, changing your underwear? Like, what do you mean it's changed?
I thought you said it was 6.95, and now you're saying it's 7.05? How'd that happen?
Exactly.
I talked to you this morning.
Really?
What did you do?
So part of it is be committed, right?
Yeah.
Be committed. And how often can you refinance, I think, is what the question we keep circling around. You can refinance as often as what you want to, as long as you've got that 6-month window in between.
Right.
Right. So if somebody wanted to refinance today and got into the 6s, say they're in the 8s,
Right.
right? And they want to go into the sixes, then could they refinance today? Could they refinance again in November or December? Which to me is one of the very best times to pick up money because everybody is backing off, meaning the investors' pipelines are not nearly as full. And if they're not as full and the only thing the investor sells is money, what are they going to do? They're going to discount their money to get those pipelines full, right? And so that October, November, December is a lovely time to look at mortgage money.
Mm-hmm.
So there was also something that I was told a long time ago, back when rates were 10%, that if you took $500 and put it towards your mortgage, we talked a little bit about this, that it's basically a guaranteed 10% return on that money, because you're essentially not having to pay 10% on that $5,000, say you put onto your mortgage, because you've now paid down the loan by that amount, and it goes back into your guaranteed savings. And if you have an extra $5,000 to refinance versus getting a guaranteed 8%, I think that probably needs to play into this whole equation. You know,
no question. It's not just the flash of refinance. And I think that's what we're talking about right now because it's such a big topic with these tariffs and with what's going on with both the equity and the bonds and yield dropping below. It's like use some good wisdom and really look at what you want to achieve.
Mm-hmm. You got to slow your roll a little bit because I think as a body of people, we jump online. We kind of like the chaos and we like the, ooh, what's that? Ooh, what's the next shiny thing? So I slow your roll and have a conversation and see if it's going to make sense.
Yeah.
And so basically, if I walked into either of your offices, you're going to say what to me? I want to refinance. What are you going to say to me? We'll start with Kristen.
I was going to say, Kristen.
Tell me a little bit about what's happening. What?
Why?
Let me see. Let me share with me what your address is.
Okay.
And I'm gonna go pull the equity.
No, it's private. I'll just
private.
I'll put it on the web, but So
So tell me about what kind of loan program you have. How long have you had the loan? What's your interest rate today? How long are you going to stay in the house? Do you want a rate and term or do you want some money?
Okay.
I would start out with just some simple things, just real quick, and then I would eventually get the address.
Okay. And if I'm wanting a cash out, does it matter what I do with that money?
Depends on debts. So again, the whole picture, the whole package. You want to take out, $100,000 and you've got the equity, but you've got, $200,000 in debt and your DTI that to income doesn't work, then we may have to use some of that to pay some of the debt off so you can get your money to go buy the other house or buy the RV or whatever the reasoning is. So it really just, the short answer is it depends.
Okay, but there aren't rules that, I'm sorry, you can only cash out and use the money for X. Correct. No. If your DTI is adequate to cover that. So it truly is cash out. It's not necessarily smart because now I guess it all depends. I'm always very conservative, so I'm the wrong person to say whether it's smart to take money out of my house and buy an RV because it just isn't something I would do, but some people want to do that. So, I can't say everybody has it's what makes America great is you can have your own choices, but it does mean that now your equity in your main place that you lay your head down has less. You have less equity.
Less. Sure. Yes, it does. But I think Kristen has a really good point that, again, it's all part of the picture of where is that debt to income. I want to take $100,000 cash out. Well, first you've got to pay off this $34,000 or $22,000 or whatever the number is in debt to make that debt to income work. And so you're there to help that person think through what it is that they're trying to achieve. right? What's the goal you're wanting to do this refinance for? Nancy, it's nothing more than dropping rate. It's nothing more than dropping the cost of my monthly payment. It's like, that's an easy one, right? That's an easy deal to put together. When you're talking about taking cash out, then you're starting to tweak it a little bit
Yeah.
more, and it's like flip the coin and flip the coin again, and then flip it again and flip it again,
Right.
and find that sweet spot that then gets 9/10 of what that borrower wants. Now it's like, okay, let's move forward. But again, it's always, where is that strike point? Where and when is it time to actually do the refinance?
I'm guessing that, there are some people who have negative equity in their home, but they have to sell because they're moving to a different city, and now they're bringing a check to the closing table. It doesn't seem like that would be a time you'd want to refi, though, right? Because there's no benefit, because now not only do you have your closing costs and your appraisal and all that, you then also are bringing a check, and that just makes the length longer, right? That you have to deal with it.
Yeah, it just the equation wouldn't make sense. It's like, you've got this coming down the road. Why would you ever be looking at a refinance in that scenario right now?
Right.
You're upside down on your equity, I think, is what you put in the equation.
Right.
So you don't have the equity to do the refinance. And so, so it's like, no, next.
Depending on where you are in the country, you're right, Rick. You are seeing pockets, and even on my real estate side of things, as I'm looking at comps for an upcoming listing, I'm not seeing a lot of, bank owned but I am starting to see a couple of short sales pop up, which is interesting.
What is a short sale?
Yeah, what is that?
I'm sorry. So basically, Mr. Customer, lost job, death in the family, what have you, and the mortgage is for $350, and unfortunately, the home's worth $300. So now, either they've stopped making the mortgage payment because they just can't anymore, and so now they reach out to the lender and say, "Hey, Mr. Lender, I would like to short sale my property, and here are the reasons." And then typically, and this is back in the 2009, 2010 days, a lot of things have changed since then to help protect the consumer, and we could probably have another show on that whole thing. But the short answer is, you then list the house, you then get an offer, it's below what, they owe, and then the lender would say, okay, yes, we will accept this, this sale as short.
Okay. And does that ding your credit score?
Yeah.
It does.
Yeah.
But it's not like walking away and leaving the keys on the counter.
No, and like I said, there's been so many rules that have changed since the crash that have, lenders are required to, do everything possible for the consumer to keep them in their property, and, by mortgage relief, we saw a lot during COVID of,
well, you can do the modification.
Modification, right? Yeah, exactly. Modification. So, yes, it will affect your credit, especially if you're not making your mortgage payment, and now you have mortgage lates, which then will affect your buying position in the future as far as the time frame. But going back to what you said, no, you don't want to refinance it.
Yeah.
It's not going to work. The numbers aren't it comes down to the numbers. So yeah, nothing's for free, and it doesn't work.
So negative equity, don't even bother, just to get a lower rate. But you're thinking, well, man, right. I could get, now my payments, I'm really pushing it on my payments because I went at the 8% and now it's 6%. But I have negative equity. My brain is saying I should go to the 6 because my payments will be lower, but you wouldn't be able to get the loan. You wouldn't be able to.
And it really just depends on where you are in the country. That was my original point, because there's some areas that you're seeing that, 4 and 5% year over year improvement in value, but you're seeing other areas where it's, less than 3 year over year.
And
So,
there are pockets that are negative right now, unfortunately.
right.
In the Sun Belt, San Antonio, a lot of the places people moved during COVID, I'm hearing, are places that are upside down right now. And so I think that's obviously that would be a question they would come to you and say, can you, but do they then, how do you know whether you're upside down? Because you've heard this stuff on the news or on the web or whatever, that you might, have negative equity, but don't you have to do a full appraisal to get there? So you're coming out of pocket for whatever that costs to find out whether you are? No?
No, you don't have to do a full appraisal. You can literally go to somebody like Kristen as a realtor and say, okay, give me a comprehensive comparable study as to what, in fact, there's a particular acronym for that.
CMA, competitive market analysis or something like that. Yeah.
And have your realtor do it, and your realtor is going to come just as close as an appraiser, but you don't have to put that money out because that appraisal goes nowhere, right? You can't use that in a refinance because it wasn't ordered through a bank. And the appraisal, you as the individual can't just go out, order an appraisal willy-nilly and say, okay, here, Mrs. Lender, use this valuation, use this appraisal. You could have coerced that appraiser as far as the government is concerned through the Dodd-Frank Act. And so in turn, that appraisal has to be ordered through the lending institution that you're looking for.
Okay.
Nancy, you don't give me all the credit for the evaluation. You can do it too. You can go on to a certain lender portal and you can pull similar information. So it's interesting. I just did this for a client and I did the CMA and then I pulled it from the lender portal that has this particular.
Did you find it almost like...
You know what? The range was right there.
Really?
So, really kind of like, it's not because Kristen said, it's because numbers don't lie. And here's my report and here's a independent, third party lender who's typically a little bit more conservative on value, especially today. And again, depending on that zip code. So you do have these two opportunities to kind of gauge where the value is. That's why I want your address, Rick.
Okay, so that's why you wanted to find out where I live. Okay.
I do.
Let's finish this with that because I think that's a great ending in the sense that how many people go, but I don't want to give you my social security number. I don't want to give you my address, but I don't want to give you, what do you mean you need a pay stub? And it's like, if you're going to jump in the game, be it a refinance or be it a purchase, you've got to be able to share. And first of all, have a desire. Secondly, be able to share your documentation. That lender wants to know one thing, and that is what is your ability to repay. All of that document or documentation is showing our, as the consumer, ability to repay.
And one little piece, I love ending there, but I also want to ask, how does being self-employed, being one of those, impact all this on the refi? Or is it just like any other mortgage? You look at the numbers, you look at the financials of the company, all that stuff, right?
Yeah. Today, I think, Kristen, I was talking to a client today about saying, look, if you can't play with your tax returns, then let's play with your bank statements, right?
God bless America.
Yeah. I mean, 4 or 5 years ago, we didn't have that option.
Yeah.
And so self-employed has never been different. It's just a different set of documentation and numbers. Self-employed, we're looking at your net dollars, in other words, after your expenses, your AGI, adjusted gross income. And for a W-2 employee, we're looking at your gross dollars.
Okay.
So to me, that's the biggest distinction, Rick, between self-employed versus W-2.
Okay. And
we
if
just analyze the income and go from there and figure out which plan. There are a lot of options. Self-employed people, don't be afraid. You may pay for it in the rate. However, there are a ton of options out there.
Yeah.
I also, playing this game for a long time, that's why I pay myself W-2. It just, as opposed to estimated, it's just something when I go to refi or do anything, I now have piece of paper that says I paid myself this and paid taxes on it, just like every other employee. So maybe that's a hint that we can let people know if they are self-employed. It isn't that much money to turn yourself into a W-2 employee. And for this purpose, would you say that makes it a little easier on your part to if they're self-employed, but and the business is profitable, but they're paying themselves a W-2, or is it 6 of one, half dozen the other in this new market or in this new world?
I don't know that I'd say it's in the new market. It depends on whether you're a sole proprietor, whether you're a sub S, whether you're a partnership, because sub S and partnership, right? You can pay yourself dividends, you can pay yourself W-2, you can pay yourself your K-1s, right? And those are different. We calculate those differently. Also on a self-employed, what you deduct, right? Some of those deductions we can go back in and give back to you as income. Depreciation, depletion goes back into income. Meals and entertainment comes back out of income. You can't do mileage and an auto expense. You can do one or the other and it comes back into income. And so it's Rick, it's a good question, but I think it's a good rabbit hole because there's a whole talk on just self-employed borrowers and what to do and what not to do. How do you best position yourself for that year? Most of the self-employed borrowers that are sharp are going to come to Kristen and I at September, October, and say, okay, I'm getting ready to file taxes. What do I need to show on income to be able to qualify for X on loan? Right. And so if they've been in business 5 years or greater, Fannie and Freddie only require the 1-year tax return. And if they've not been in business greater than 5 years, then you still need the 2 years tax returns. And you're then taking that income and dividing by 24 if you're doing the traditional way of underwriting that file. Right.
And is the income improving? Yeah, no, but is the income improving or is it declining?
Right.
You're calculating all these different things. And to Nancy said earlier, show me your stuff.
Including my address. Okay, fine.
Exactly.
I love it.
Which should be on my W-2 or my pay stubs as well. But yeah, this has been a great discussion. I think it'll be great to maybe do a whole show just on self-employed and what they need to consider and how they need to get to closing and what they need to do. And it's probably as much just getting ready, like you were saying, and not just making an assumption, well, I got a mortgage 5 years ago when I was working for XYZ Corporation. It was easy. Now I've been self-employed for 2 years. Is it the same? And it may or may not be, but that's why you want to have this discussion as well. And so I really appreciate the discussion today, though. I think this was really valuable for our viewers to find out. And of course, if you want to get a hold of Kristen, you can do so by reaching her at the number there on the screen. And of course, Nancy as well. And they'd love to take your calls, love to talk to you about what is involved in refinancing and whether your numbers make sense. So I'm sure you'd like to reach out to them. It would be a great opportunity for you to find out more information about your own situation. And that's what they love to do. It's what they spend time doing. And so appreciate you being on today and look forward to seeing you maybe in a couple weeks or something. How's that sound?
Very good.
That sounds so good. Great seeing you, Nancy. Great seeing you, Rick.
Thanks.
Have a great day.
See you soon.